Welcome to this deep dive. Our mission today, well, we are going to analyze a really wild 24-hour window, specifically May 14th and 15th, 2026.
Right, because we saw a massive algorithmic short squeeze collide with sovereign geopolitics, historic legislation, and, domestic stagflation. It was a lot.
It really was. Usually,
Sure.
when interest rates stay high, inflation spikes, and employment cracks, the heavy macro anchor drops. Risk assets just go straight to the bottom.
Yeah, that's the textbook reaction. The
Uh-uh.
macroeconomic gravity pulls everything down.
Exactly. But looking at that window, Bitcoin completely broke that rule. It didn't just ignore the drop. It used that downward pressure to launch itself upward.
Yeah.
So, okay, let's unpack this. The U.S. data hits, and it confirms stagflation. Jobless claims spiked to 211,000.
And retail sales optically grew 0.5%.
Right. But it was entirely driven by a 2.8% surge in gas station sales. Ex-gas retail was an anemic 0.3%, so the consumer is essentially suffocating.
Basic logic dictates a crash there.
Yeah, but instead, Bitcoin hits $79,300 and just, rips into a brutal algorithmic short squeeze, bouncing to an intraday high of $82,029.40. Think of the market like a tightly compressed spring.
Oh, I see where you're going with this.
The bears saw the terrible macro data and piled on heavy short positions, which pushed that spring all the way down.
Right, and then the algorithms use those exact forced buy-to-cover orders as synthetic fuel to drive the price up. Anyone trying to front-run a macro collapse was suddenly trapped.
Trapped, exactly.
We saw $153 million in short positions liquidated globally. Just a massive snapback.
So the algorithms weaponized the panic. But why didn't the market eventually capitulate to the bad economy?
Well, because the traditional finance architecture and its legal foundation permanently locked in that very same day.
You mean the Hana Bank move?
Exactly. South Korea's Hana Bank suddenly deployed $670 million for a 6.55% stake in Dunamu, the operator behind Upbit.
Which is huge.
Right, and simultaneously, the U.S. Senate Banking Committee advanced the Clarity Act in a 15-9 vote. They defeated the anti-DeFi amendments, preserving open-source developers' safe harbors.
Wait, hold on. I need to push back on that. Isn't the Clarity Act a massive double-edged sword? There's an integrated compromise in there that explicitly bans digital asset providers from paying passive interest on stablecoins.
Yeah, that is definitely the controversial part.
It seems like a huge blow.
If we connect this to the bigger picture, the crypto industry surrendered the battle over stablecoin yield to the commercial banking cartel.
They just gave up that territory?
Yeah, to secure legal certainty and traditional finance balance sheet integration. They conceded it so legacy banks could protect their deposits.
Wow. So they effectively begged for a seat at the table? That is a wild compromise. Okay, so that's the legal part. But we need to move from the digital market structure to the physical reality.
You mean the energy needed to run the network?
Yeah, and the geopolitics required to secure that energy. Energy inflation is just crushing miners right now. I mean, look at CleanSpark reporting a $378.3 million net loss.
Right, the margin compression is brutal.
It is. It's forcing a systematic pivot away from crypto to host AI cloud computing.
Miners are just becoming agnostic energy arbitragers for AI.
Exactly. So what does this all mean for you? Well, consider the profound irony here. A decentralized protocol's immediate fate rests heavily on a diplomatic agreement in Beijing.
The Trump and Xi summit.
Right. They
Yeah.
just concluded negotiations. Trump suspended a $14 billion arms sale to Taiwan.
And in exchange, Xi committed to embargoing military equipment to Iran and keeping the Strait of Hormuz open.
Which is wild, because that diplomatic trade-off is meant to protect the semiconductor supply chain in Taiwan.
Bringing the hardware vulnerability right into the spotlight, the physical chips required to mine the asset are entirely dependent on these incredibly fragile agreements.
So the asset is currently trapped. On one side, you have the relentless gravity of global inflation and energy costs.
And on the other side, the irreversible integration of sovereign and institutional capital.
Which leaves you with this final provocative thought to ponder. If Tier 1 legacy banks are buying up the matching engines and miners are becoming agnostic energy providers for big tech's AI...
The infrastructure is totally shifting.
Yeah. So is the underlying infrastructure inevitably destined to be completely assimilated by the very traditional finance and big tech giants it originally sought to bypass? Think about that.